What happened at Silicon Valley Bank? Last week, Silicon Valley Bank. For Silicon Valley Bank, I don't know what the official definition of a bank run is, but that is a bank run. It's about people's behavior and panic that really can impact the financial system, and we don't really know how that is going to play out. For Silicon Valley Bank in particular, it is mostly companies and venture capital firms. They were getting a lot of withdrawals, they didn't have enough deposits, bond values were down, and they needed fresh capital to maintain reserves and operations. But unfortunately, we're in the midst of a financial and banking crisis in the United States. Last week, Silicon Valley Bank, which was the 16th biggest bank in the United States, collapsed and was seized by federal regulators. Over the weekend, Signature Bank, which is big into the crypto industry, was seized. Now we're seeing First Republic Bank in California. Their shares are down 50% today as of Monday, March 13th. So we're seeing a lot of pretty frightening things. There's been a run on the bank. There's been federal intervention. And this really matters for investors of all types and just regular Americans who use the financial system and the banking system in the United States. And there is a lot to unpack here, and the story is absolutely still evolving. But the financial system is super complex and interconnected, so we need to at least try to understand if some of the issues that were present at Silicon Valley Bank might be present in other financial institutions, and that's what we're going to do today. We're going to just do a basic look at how the banking system works at a high level, what happened at Silicon Valley Bank, why it's happening now, if this issue can spread, and of course, how this impacts real estate investors like you and me. Hey everyone, what's going on? My name is Dave Meyer. I'm the Vice President of Data and Analytics at BiggerPockets. And just want to remind you, if you do want to stay on top of economic news like what we're talking about here today, you can do that by checking out my podcast. It's a BiggerPockets podcast called On the Market. It comes out every Monday and every Friday, and we cover mostly real estate investing news. But when big things like this come out, we cover it as quickly as we can through the lens of a real estate investor. So if you are involved in real estate at all and want to stay on top of the financial system, economics, news, definitely check out On the Market. It's available on Apple, Spotify, and we also have our own YouTube channel. Just type in On the Market. Okay, so to understand what went on with Silicon Valley Bank last week, we do have to go a little bit back and just talk about how banks work. And I know everyone sort of knows, but let me just cover some of the most important things here that are relevant to this conversation. So as we all know, banks take in deposits. People like you and me or businesses, they take their money, they put them in a bank for safekeeping and maybe to earn a little bit of interest on a savings account. For big banks, like Chase and Wells Fargo, it's a combination of just normal people and businesses. But for Silicon Valley Bank in particular, and this is going to come up a few times throughout the video today, it was mostly companies. They have a very small number of, just individuals who are depositing there. It is mostly companies and venture capital firms. So banks, they take in these deposits and then they lend it out as a profit. So it's not like when you go and put your money in a bank, it actually just sits there in a vault or something. The bank takes that money and lends it out to other people. Like as a quick example, if you deposited $100,000 into a bank, that money might be lent out to someone else as a HELOC or a mortgage or a small business loan. In order to prevent banks from basically lending out all of the depositor money and having no money on hand, federal regulators require that banks keep a certain number of deposits in what they call reserves. And usually it's about 10%. It changes based on the size of the bank, different timing and stuff, but it's about 10%. And so banks have to have that money on hand in case a depositor comes and walks into the bank and says, I wanted to take out some money. This usually in normal times works really well because it's pretty rare that all the people who have their money in the bank want their money at one time. However, problems can arise with the system if everyone, for one reason or another, wants to take their money out of the bank at once. And this is what is known as a bank run. If the bank doesn't have enough money for everyone who wants to make withdrawals, that can cause what's called insolvency, and the bank can basically fail. Federal banking regulators have some protections in place to prevent bank runs and to stabilize the financial system when times of crisis or panic. Okay, so that's the context. Now let's talk about Silicon Valley Bank. Remember, I said Silicon Valley Bank is a little bit different from a lot of other major banks you've probably heard of, is because they mostly work with companies. Specifically, they're very, very concentrated in the tech sector. Think of small startups and the venture company capital firms that fund those startups. That's their bread and butter. That is the niche of the banking industry that they cater to. And during the pandemic, over the last couple of years, these types of companies have exploded. In 2021 alone, the total deposits at Silicon Valley Bank grew 86%. The bank wanted to earn a return on all of these deposits, like we were just talking about. And so they lent out some of that money, and they put a lot of that money into U.S. treasuries and other government-sponsored bonds. And that's usually a safe thing to do because U.S. treasuries are generally considered the safest investment there is. And that's usually all well and good until, of course, the Fed started raising interest rates a year ago. These interest rate hikes have had two impacts on Silicon Valley Bank. First and foremost, the tech sector, which Silicon Valley Bank supports, has been getting absolutely hammered. Funding for startups has dried up, and startups are burning through their cash faster than Silicon Valley Bank expected. So SVB relies on these deposits, but instead of the companies keeping their money in the bank like they normally do, the companies need the money to hire people and to run marketing campaigns or whatever. So they've been withdrawing money faster from the bank than SVB expected this. And so that ultimately means that SVB didn't have enough reserves on hand. Actually, this has been going on for several months. Towards the end of 2022, Silicon Valley Bank went from net inflows of capital to net outflows. Basically, they were losing total deposits in their bank for the last several quarters. So that was one thing that really impacted Silicon Valley Bank, is that they had less deposits, and so they didn't have enough in reserves. The other thing that happened is normally, when something like this happens, Silicon Valley Bank could be like, oh, I have all these government bonds that I've bought with all this money. I'll just sell those bonds off, and then I'll have enough reserves. The problem is that, again, due to rising interest rates, the value of bonds Silicon Valley bought declined. So I know this is a little bit wonky, but basically bear with me for just 1 second. So Silicon Valley Bank bought bonds primarily during the pandemic. So you buy a bond, let's say for $100, and you get a quote unquote yield, which is basically the interest rate you earn on that bond. And during the pandemic, yields were very, very low. They were between 1% and 2% for a 10-year treasury, which is historically low. But Silicon Valley Bank wanted to invest in something relatively safe, and so they bought these government bonds. And when I say safe, what I'm saying is that the government pays that 1% to 2%. But as you'll see, it's not entirely safe because the value of those bonds can go up and down because there is a secondary market for bonds where people buy and trade them. And so Silicon Valley Bank, they needed reserves. And so then when they went to go sell these bonds, the unfortunate thing is that no one really wanted them because these bonds had yields of 1% to 2%. If you look at bond yields right now, like today, watching this, it's probably somewhere around 3.5% to 4%. And so if you had the choice of either buying Silicon Valley Bank's bonds, where it's yielded 1% to 2%, or you could just go buy a new bond for 3 or 4%, obviously you're going to go buy the 3 or 4%. So not a lot of people want those bonds unless they discount them. So that is the only way Silicon Valley Bank was able to sell these bonds, is at a lower rate. They were discounted. And unfortunately for them, that meant that the total value of these bonds was not enough to make up for the reserves that they needed. This put Silicon Valley Bank in a bad way, and last week things sort of came to a head where they saw that they didn't have enough reserves, they were getting a lot of withdrawals, they didn't have enough deposits, bond values were down, and they needed fresh capital to main reserves and operations. So in order to fix this situation, they basically tried to go raise money from private investors, and they hired Goldman Sachs to orchestrate a private stock sale from private equity investors, but it didn't work, basically. Moody's Analytics downgraded Silicon Valley Bank's credit rating, and the market found out about the private stock sale, and basically people got spooked. And the following day, stocks of Silicon Valley Bank started to tank. The CEO publicly tried to reassure people, but clearly we all know that didn't work. And the big thing that happened here that I personally believe was a main catalyst for this is all these venture capital firms. The way this works is like all these venture capital firms invest in these small startups, and they're very involved in the startups' operations. And all these big venture capital firms basically emailed the companies that they invest in, and they're like, stuff is going down at Silicon Valley Bank, and you might not be able to get your money out. There might be a bank run, and told their portfolio companies to withdraw their money immediately. And I've seen a few of these emails. They were pretty dire, and basically all the startups listened. They started to try to withdraw their money. So it was really dire, and people rush to withdraw their money, and for good reason, because there isn't a guarantee that even if you deposit your money in the bank in the United States, that you can get it out. The way the banking system in the US works is that deposits, if you go and put money into the bank, those deposits are guaranteed by the government, but only up to a certain amount. At Silicon Valley Bank, and basically all banks, the first $250,000 is insured by something called the Federal Deposit Insurance Company. You might have heard it. It's called FDIC. Like at the end of the banking commercials, they're all like, FDIC insured. That's what they're talking about. So after that, anything above $250K, you're basically risking your money by keeping it in a bank, because that bank can lend it out and they can lose money on that. And hopefully that doesn't happen, but it is possible. That is not normally a problem, right? If it's just an individual, it's pretty rare that most people don't have more than $250,000 in a single banking account. But again, because Silicon Valley Bank is mostly businesses, a lot of them had over $250,000. In fact, it was estimated that about 86% of all the deposits in Silicon Valley Bank were not insured. It was like $150 billion were not insured. So that's why all these venture capital firms are freaking out. They're like, oh my God, if there's a run on this bank, there is this huge amount of money in Silicon Valley Bank that is not insured. And if there are huge losses at the bank, people might not be able to get their money out. They might not be able to, and even if they can get it out, it might take a really, really long time. And so that's why these venture capital firms were like really interested, and the startups listened to them and started taking out all this money. This resulted on March 9th alone of over $42 billion being withdrawn, which was about a quarter of the bank's deposits in just a single day. I don't know what the official definition of a bank run is, but that is a bank run. The fearing sort of a broader situation that one could lead to real insolvency at Silicon Valley Bank and then spread throughout the financial system, the FDIC, Federal Deposit Insurance Company, stepped in, took over the bank, and that's what happened on Friday. So far, what we learned over the weekend is that the FDIC has said that they will return all of the money. That came out on Sunday. At first, people were really afraid because, again, there was $150 billion of uninsured funds. But over the weekend, the government wanted to step in to prevent a further financial crisis. And basically what they said that they were going to do, they basically said that they were going to do three things. So the first thing is that the FDIC took over a second bank, which is Signature Bank, which is a lot of ties to the crypto industry. It's not as big as Silicon Valley Bank. It's about half as big with I think about $110 billion in assets. So that's the first thing they do. The second thing they did, which I think is really, significant here, is the FDIC said it would guarantee payments of all deposits. So all that uninsured money at Silicon Valley Bank is no longer at risk because the feds will make everyone whole. And so I talked to a friend of mine in finance who said that he thinks Silicon Valley Bank, they did this whole analysis, should be able to sell all their assets and pay everyone back. But even if they can't, the feds are basically saying, no one worry, the losses will be covered by the FDIC, and they are saying that the taxpayers will not be footing the bill, that they will basically sell SVB assets, and if they can't make everyone whole with just SVB assets, they will issue some special assessments on banks and use that to pay everyone back. It won't come from taxpayers, at least according to the FDIC. So those are the first two things that they've done over the weekend. The third thing was that the Federal Reserve came in and loosened the rules around accessing reserves. They can borrow money. Most banks can borrow money from the Fed to access reserves and maintain their reserves, but there are rules around that. The Fed has basically said that they are going to relax those rules so that other banks won't face the same issues that SVB did. All of these actions over the weekend were meant to calm down investors and the general public alike because basically people were afraid and still are afraid that other small banks would fail. And I've looked at a lot of, balance sheets and analysis over the weekend, and a lot of the big banks look fine on paper. But the thing about banking and the way the U.S. banking systems work is that it's not just about the banks and their behavior and their balance sheets. A lot of it is about people, right? If, for example, the Silicon Valley Bank, those venture capitalists didn't tell everyone to withdraw their money all at once, Silicon Valley Bank maybe could have raised private capital and we wouldn't be talking about this. But it's about people's behavior and panic that really can impact the financial system. And we don't really know how that is going to play out. Now, I am recording this on Monday, on March 13th. And as of this time, the financial system still is intact. What we're seeing right now is that First Republic Bank, while another bank in San Francisco with strong ties to the tech industry, is not doing very well. Not necessarily insolvent, but their stock has declined like 50% over the last couple of days. So that's basically where we stand right now. So the feds have stepped in to try and stem this crisis, but we shouldn't overlook the fact of what has happened so far. Silicon Valley Bank was the second biggest bank collapse in history. This is a historical event. The last time something like this happened was when Washington Mutual collapsed in 2008. They were huge. They had assets over $300 billion. And so it's really, a significant event right now. And, just a few days after this, it's really hard to speculate all the different ways that this might impact the economy. So I'm trying here to just give you an update and explain what has happened so far. But this story is obviously changing in real time. And so I'm going to regularly keep an eye on this, and I will provide updates to you as frequently as I can. As of right now, Monday, March 13th, it does seem like the issue is slightly contained. People seem to, most investors in Wall Street seem to be relatively calmed by what the Fed has done, but there is still a lot of uncertainty and there still is risk in the system. I think it is far too early to say whether or not this is going to impact the real estate markets. As of right now, I don't think it has yet, but we really do just have to wait and see how this plays out over the next couple of weeks and months. And here on the BiggerPockets YouTube channel, we will definitely do that. So if you want to hear those updates, you want to get more information, make sure you're subscribed to the BiggerPockets YouTube channel and sign up for notifications so you are notified anytime we release a new video. Thank you all for watching. Would love to hear what you all think about what's going to happen with this whole situation in the comments below. Thanks again for watching. We'll see you next time.